Arvind in Montreal. Go ahead, Arvind.
I want to talk about KKR quickly. This stock goes down at slightest or no provocation. February sell-off, market goes down 12%. KKR obliges by going down 16%.
Okay.
It just seems to gung-ho wants to go down. Is there something I don't know, something complicated that a simpleton like me, won't know? So I defer to your superior intelligence and tell me whether I should still hold on.
Very modest. Thank you, Arvind.
Okay. So Arvind, KKR, of course, is an alternative asset manager. They have big investments in private equity and other alternative assets. And so, as you can imagine, their exit from some of the investments is selling them to the public market. And when the public market has a correction, that raises questions whether they will be able to exit some of their positions at the prices they'd like to exit them at. I would say this. I believe this was a short-term correction in equity markets. And so while they are very market sensitive, I would say that if my belief is that we are in a long-term structural bull market in stocks and that we have significant upside yet to see this year, then this should benefit alongside. Now, in the last couple of years, KKR has performed extremely well. So in the last 12 months, it's outperformed 81% of the stocks in the S&P 500. And I tell you, I would buy the stock right here. We really like asset managers. We really like capital markets. They benefit in strong markets. And I'm going to talk about one today. But listen, I would be a buyer of KKR. It's about 9-10 times earnings. And they are going to have a great opportunity over the next few years to monetize some of the investments that they've been making over the last number of years. And it certainly did not break long-term trend. It pulled back within trend. And so I would be a buyer of the stock, and I would not let it go here.
Kathy in Belleville, Ontario. Go ahead, please.
Yes. Hi, Andy.
Hi there.
Thank you for taking my call. I would like your guest's opinion on CCL Industries. Is it a good time at this point to still buy it, and does it pay a dividend? Thank you.
Okay.
Check that out.
So CCL pays $1.20, so it's a nice dividend. And the dividend has grown nicely over time, like it's grown 28% a year over the last 3 years. That's pretty substantial. It's a great company. They've been successful for a very, very long time in multiple product lines, but mostly around packaging for consumer products and labels. The stock had a pretty good pullback from 65 to 54 in January, and has since rallied sharply off it, basically to set a new recent high. So technically, the stock looks pretty good. I mean, listen, there's lots of companies to own. This one's a very good one. It's not overly liquid, so it's harder for institutions to invest in it, but they've had a very, very good growth record. So I think that pullback definitely shook some people out, but the recovery's been sharp, and I think that I'd be comfortable owning the stock here.
Not a huge yield, or about 0.8%.
Yeah, but it's, you've got to. But this is what I'm talking about. You want companies that are growing their dividends rapidly. This is what will do better than the traditional dividend stock, which is a high dividend payer, but with very low dividend growth.
Charles in Montreal, fire ahead, please.
Good afternoon, gentlemen.
Hi there.
I'm trying to buy Canadian companies whose revenue comes mostly from outside Canada and preferably outside U.S. And since I have no oil and gas in my portfolio, I was thinking of Vermilion. What's your opinion on that?
Thank you, Charles.
So, Charles, I'm not a fan of energy sector currently. I always scroll through, I don't know, maybe 1,000 charts a day. And what continues to strike me is how poorly energy shares are behaving, especially relative to energy itself or the oil price itself. I think that we historically had lots of foreign investors come to Canada to buy our oil and gas companies. And as it stands right now, there's a lot of choice outside of Canada. A lot of great growth companies in the U.S. with very low finding costs, and even they aren't performing very well. So, 80% of return comes from getting to the right neighborhood. Nice house in a bad neighborhood doesn't make you much money. And so I would look elsewhere for return right now than in the energy patch.
None of it interests you, even as a potential value play. I mean,
I'm not a value investor,
No.
Andy. I'm in a bull market, and there's lots of choice, things that are acting well today. We get paid to make money when the sun is shining,
Yeah.
and you're sitting on an asset that's not appreciating in a great bull market. It doesn't make sense.
cheap for a reason, as they say. Okay, we are going to have David Burrows' top picks after this. Remember, he has a technology name that you may not have come across before. We'll be right back.